In the past year, we have seen some sectors deliver stellar returns. Take the Nifty India Defence Index as an example. The index is up 200%. Similarly, the Nifty PSE Index is up 123% and the Nifty Realty Index has given 114% returns. But this is nothing new. Every year, you will find sectors that have done extremely well. We looked at the performance of the top 3 and the bottom 3 performing sectors over the last decade. There's a huge difference in their performance. But for retail investors, timing the entry and exit is difficult. However, there are mutual funds whose mandate is to do exactly this. We are talking about business cycle funds. Their objective is simple. Invest in sectors that will do well in the prevailing economic scenario and exit them before the correction happens. In today's video, we will examine these funds. We will look at 3 aspects. First, we will discuss their investment strategy. Then, we will check their portfolio to see if they have managed to invest in the best performing sectors. Finally, we will evaluate their performance. We will also discuss a new fund Edelweiss has launched in this category that takes a unique approach to identifying business cycles. This video is going to be very interesting, especially if you like flexi cap or momentum strategy. So I recommend you to stick to the end. But before we begin, a quick update. You're watching this video on our English channel. हमारा एक हिंदी चैनल भी है जहाँ पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are or if you know someone interested in understanding the basics of finance, we also have a channel called 5-Minute Finance. I recommend you check out these channels. I've attached their links in the description box below. Okay, so let's move to the first section of this video and examine the investment strategies of the business cycle funds. Most of these funds select sectors based on the prevailing economic cycle. So before we discuss their investment strategy, let's first understand the different phases of an economic cycle. Broadly, economic cycle has 4 phases. First, we have the expansion phase. In this phase, the interest rates are low, so businesses invest in new projects, hire more workers, and increase production capacity. This results in more employment and higher consumer spending. So during this phase, GDP metrics grow, but inflation also starts picking up. The next phase in the cycle is where economic activities are operating at their peak. Here, the economy has high demand, so factories are operating at their peak. The economy is running at full capacity and inflation may be at its highest too. At this stage, the central bank increases interest rates to cool off the economy. This marks the beginning of the next stage, which is the contraction. Here, the cost of capital starts to rise, so companies reduce production, delay or cancel investment projects, and even lay off workers. Overall demand for goods starts to decrease during this phase. The 4th phase in the cycle is the slump. In this phase, the economy hits a low point. When this ends, another economic cycle begins. Now, at each phase of the economic cycle, different sectors and businesses are likely to do well. For example, due to lower interest rates, demand for loans, houses, cars, and other discretionary items increases during the expansion phase. So businesses such as banks, real estate, infra, metal, jewelry, and related companies do well. Similarly, the interest rates are higher when the economy is in a contraction phase. So consumers limit their discretionary expenditure and the expenditure is limited to essentials. Here FMCG, pharma, and energy businesses do better. Now, this was a simplistic version of how the economic cycle affects businesses and their performance in the medium term. In reality, this relationship is much more complex. Global and domestic factors impact each sector differently. Then, an industry-specific cycle, such as renewable energy, could differ from the ongoing economic cycle. Still, fund houses use multiple data points and their expertise and try to time their entry into the sectors. So, as the first step, most business cycle funds do a top-down analysis and shortlist sectors that could do well. Next, these funds do a bottom-up analysis to select good companies from each sector that can give outsized returns. Now, let's look at these funds' portfolios to see how well they do sector rotation and compare them with other diversified funds. But before we proceed, if you haven't subscribed to our channel, I recommend you hit the subscribe button and press the bell icon so you never miss a video from us. Now, most business cycle funds use Nifty 500 as their investment universe. So they invest in large cap, mid cap, and small cap stocks. But we wanted to check if their portfolios are skewed towards any particular segment. For this, we looked at their market cap allocation. What we found was that they don't have any particular preference. Some have higher large cap allocation, while funds like HSBC Business Cycle Fund have a high small cap allocation. Next, let's analyze how well these funds do sector rotation. For this, we looked at the sector allocation of the HSBC Business Cycle Fund. Now we took this scheme because it is the oldest scheme in the category. Surprisingly, we found no significant shift in sector allocation in the last 10 years. The most popular sectors such as banks, auto, infra, chemicals and oil had some allocation most of the time. The allocation changed from year to year, but not too significantly. Now this is contrary to what we expect from a business cycle fund. So we looked at another fund to see if this HSBC Business Cycle Fund was an exception. We looked at ICICI Business Cycle Fund, which is the second oldest scheme. Although it's the second oldest, it was launched in January 2021. So instead of annual data, we looked at the quarterly data for this fund. We saw a similar pattern persist. Most sectors had an allocation most of the time. So sector rotation, which is the USP of these funds, is not evident from the sector allocation data. Now we went a step further in our analysis. We compared the portfolio of the ICICI Business Cycle Fund with the ICICI FlexiCap Fund. We did this to see if the sector allocation of a business cycle fund is significantly different from a diversified equity fund or not. Now, as of March 2024, the business cycle fund has the highest allocation to banks. This was followed by the auto sector and the infra sector. Now, if we compare this with the sector allocation of ICICI FlexiCap Fund, then auto and bank were in the top 3 sectors here too. But one noticeable difference was the FlexiCap Fund's 16.82% allocation to the retail sector. The business cycle fund had allocation of less than 1% towards the retail sector. However, apart from these few differences, the business cycle fund of the ICICI was not very different from its FlexiCap fund. Now, based on what we have discussed so far, you would expect a business cycle fund to have a high allocation to a few sectors. After all, they tend to invest in sectors that are going to outperform others. But here also data suggests something otherwise. In the case of the ICICI FlexiCap Fund, 3 sectors constituted 50% of the fund's portfolio. However, in the ICICI Business Cycle Fund, 5 sectors constituted 50% of the portfolio. Further, we checked the number of sectors in other business cycle funds and found a similar trend. Most of them have allocation to around 20 sectors. So, based on this data, it appears that these funds are not very sectorally concentrated either. Now, after looking at the portfolio data of these funds, one thing is clear. The sector rotation is not very aggressive in the current version of these business cycle funds. But there is a new entrant in this space that could turn out to be different. Edelweiss Mutual Fund has launched a new business cycle fund on 9th July. Now this fund has a very different stock selection approach. Instead of using the economic cycle to predict which sectors will perform, the fund invests in the stocks already performing well. Let's look at the investment process of this fund to make sense of what I just said. The fund's investment universe is the top 300 stocks by market cap. It scores every stock on 3 factors: quality, growth, and value. Now, once stocks are scored on each factor, the fund house uses 3-month and 12-month prices to allocate a momentum score to these stocks. Then, it combines the momentum score with the quality, growth, and value score. So, each stock will have a quality plus momentum score, value plus momentum score, and growth plus momentum scores. Finally, the fund selects the top stocks from each factor. This way, it constructs a portfolio of 58 to 60 stocks. Now, some of you may be wondering how this is a business cycle fund. Well, the answer to that question is in the momentum factor used in the process. By selecting stocks with good momentum, the fund indirectly allocates capital to sectors with good momentum. This approach leads to a dynamic sector rotation in the fund's portfolio. I've attached the presentation of the scheme in the description section below. You can go through it, and if you wish to invest in the NFO, you can do so on the ET Money app. Now, let's move to the final section of this video and compare the performance of these funds. One challenge we faced while looking at the performance of these funds was their limited performance history. Currently, there are 12 funds in the category and only one has a performance history of more than 5 years. The other 11 funds are relatively new, with most having a performance history of less than 3 years. So, to evaluate performance, we decided to look at their SIP returns for 2 years and trailing returns for 1, 2 and 3 years. Now only 5 funds qualify for this. Even though this period is short to evaluate equity investments, this was the best we had. Now there is another point we would like to highlight. We have compared the performance of the schemes with flexicap funds, the Nifty 200 Momentum 30 Index and the Nifty 500 Index, which is their benchmark. Now we chose flexicap because its investment style and inverse are similar to business cycle funds. We took the momentum index because, like business cycle funds, momentum investing indirectly participates in sector rotation by investing in stocks with high momentum. Okay, so now let's look at the SIP returns first. Here, 4 out of the 5 business cycle funds have performed better than the benchmark and average returns of the flexicap funds. However, all 5 business cycle funds have underperformed the Nifty 200 Momentum 30 Index by a wide margin. Next, we looked at the 1-year trailing returns of these funds. 9 have a history of more than 1 year, and 6 out of these 9 funds have done better than the average of flexicap funds and the Nifty 500 Index. However, all 9 funds underperformed the Nifty 200 Momentum Index. Next, let's look at the same data for 2 years. Here, 4 out of 5 funds did better than the flexicaps and Nifty 500 Index. However, as we saw in the previous 2 cases, all 5 funds have underperformed the Momentum Index. Lastly, if we look at the 3-year trailing returns, there are only 2 funds that are at least 3 years old. Here, the results were surprising. As we saw earlier, these funds outperformed flexicap funds and the Nifty 500 Index. However, the HSBC Business Cycle Fund managed to outperform the Momentum Index. The ICICI Business Cycle Fund, on the other hand, had returns similar to the Momentum Index. So, after looking at the returns, these funds seem like a better alternative to flexicap funds and the Nifty 500 Index. However, they haven't done exceptionally well if we compare them to the Momentum Index. But before we get fixated on these conclusions, let's compare their risk profile too. Now, to evaluate their risk, we decided to look at their downside protection. And to evaluate downside protection, we looked at the periods when Nifty 500 corrected by more than 5% in the last 3 years. Now there were 8 such periods. We compared the performance of the business cycle funds against the index during these periods. For example, out of these 8 periods, the momentum index did better only in 3. It fell more aggressively than the index when market saw correction. The flexicap funds did better in 5. If we look at the performance of different business cycle funds, the performance is diverse. We have funds like ICICI Business Cycle Fund, which showed a better downside protection in 8 out of 8 periods. On the other hand, HSBC did better in only 3. Overall, these funds' downside protection is similar to that of flexicap funds and better than that of Momentum Index. Now, if we combine the findings from return and risk analysis, the business cycle funds do have an investment case. They have performed better than Nifty 500 Index. Their return is better than flexicap funds and their risk profile is similar. Finally, even though they have underperformed the Momentum Index, they have a better risk profile. The data shows they are a good option if you want to invest in funds that give better returns than flexicap funds but are not that aggressive. Do remember one thing though, most of these funds are new and they don't have sufficient performance history. So don't go big on this. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll see you soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.